So, Seth, everybody knows your storied career in private equity, and as Laura was mentioning, you are really focused on philanthropy right now. So we will get into the private equity discussion, but why don't we start with that? You have some pet projects that you're really excited about, and it'd be great to learn more.
Yes, it started as a rat pet project. It's turned into a pit bull pet project. I grew up, I was born in Harlem, then lived in Newburgh, New York, actually, both very predominantly poor areas. And if I look at what's going on in our country today, one of our biggest weaknesses is children. They're being neglected. My kids come home to a mother with 5 children, all tutors, great education, public education, not private. And I think what we need to do is invest more in these children because they're hungrier. A kid that's going to come out of Harlem or Brooklyn or Queens in my schools, we have also a program called SEO with Henry Kravitz. And you look at these kids and they want to get out there and make a difference. They want to change. They want to change where they came from. They just don't know they can. I didn't know I could until I was thrown into the workforce. Ray, as you heard, is my college roommate. And Ray and I are sitting on the floor. He's playing. I'm not playing, clearly. And the guy next to me happened to be the owner of the Nets and founder of ADP and gave me an opportunity. If that opportunity didn't come along, I could be still bouncing in a bar. I could be doing things that I'm not so proud of as I was being introduced as. So before we go on to making money, I think it's very important for all of us. We're also fortunate to be able to focus on giving back, and giving back to something that's relative to you and passionate to you and genuine.
That's very powerful. Can you talk a little bit about your experience working with these kids and what drives you to do more?
Yeah, I mean, it's so much fun because you have kids that, just like anything else, it's a challenge, to get across to these children that they can do it. When I talk to these kids, I always tell them, let's make the video game, not play the video game. Let's code in high school. You don't have to go to college. College is not for everybody. You can produce the music, not have to be Beyonce singing the music. I tell them writers make more money than a lot of times the people that are actually singing, especially in today's environment, streaming. So I think what I love is getting in front of thousands of my students, and I try to speak to my students once a week in my school, different schools. And what I really enjoy and really love about speaking to my students is seeing that we're going to walk out of there and 1, 2, 10 of those children are going to feel they have that chance. And to hear it from somebody that started in their shoes and sat in their seat and had it a lot different than they did in some cases, to be able to still go on and make it. Anybody can make it if you have the passion, desire. It's not the world of 50 years ago. Today there's scholarships, there's programs, there's many different ways to do things and get to where you need to get to. The key is to be able to actually use them, utilize them, and feel that it's actually, unfortunately in some places it's not cool to be smart and get a good education. So I think by doing that and speaking to these students, I get such a pleasure to see these kids and the smiles on their faces. I tend to bring a lot of guests with me because I'm not the Seth Bernstein of 15 years ago, as she wonderfully pointed out. I'm not 230 pounds and shaved head anymore. So they don't know the Seth Bernstein of today. They just know I own these schools and started these schools. So I like to bring fun guests to bring, they could relate. And so when a Jay-Z introduces you, now I'm cool, I guess.
That's great. Let's turn to private equity. You have been focused on a lot of different media deals. We were talking earlier about your involvement with Thomson Reuters and some other companies. And it'd be great to start with, what drives you in looking for deals, especially in an industry that's so up and down as media, and how you think that private equity can continue to create value going forward.
Yeah, so we'll take a step back from just media. And you look at private equity, 25 years ago, the same 5 top firms are still the same top 5 firms. 20 years ago, there was about 30, 25 mid-sized market funds. Today, there's almost 3,000. So the money is being driven to new funds, people coming out of funds like Blackstone and Carlyle and other firms. But they forget that, when you walk in an office with Blackstone, you have the ability to have all these people around you. It's very difficult than being an entrepreneur and now starting. It's not just doing deals. It's doing deals, finding the right deal, underwriting the right deal, and able to grow the business and to be successful in that. So I don't think private equity in general will change. If it hasn't changed in 25 years, the big deals, the Thomson Reuters that we did, the regional sports networks that you might have just seen, we just announced with Sinclair, Amazon, and myself, these deals are always going to get done by the large firms, because there's only 5 firms that can hold $2, $3, $4, $5 billion cheques. So with that said, to me, thematically, what's different in private equity today than it was 20 years ago? 20 years ago, you had Henry, Steve, David, which spoke yesterday. You had people that were actually in the deal. So David was going out, and I don't know if many people know, David actually was the original investor in Amazon, which isn't talked about very often, but I think it's a wonderful story. I'll let him tell it one day. It's his story. But for him to actually have been an initial investor in Amazon is very interesting. But today, the leaders and people have made billions of dollars that they've made, and people get criticized for that. They're no different than entrepreneurs. They took a chance, just like I did. They put a name on the firm, wasn't their last name, but they put a name on their firm, and they raised capital, and they did good deals and got good returns. The question is publicly held companies. So 20 years ago, publicly held companies still got very similar or not too dissimilar returns as private equity. They're not today. So you're not getting 20% returns at most publicly held companies that you are at Blackstone or Carlyle, Silver Lake, and other firms. So, and the issue is there is then you're not be able to recruit the best talent for the CEOs. The CEO is living a lifestyle off of that company. In a lot of cases, their board members surrounding them are getting a couple $100,000 fees, and they're not incented. So they're not incented the same way that private equity is. So I think one of the things that needs to change is, and I think SPACs have an interesting place to make that change, except, excuse me for using my football terms, but it's like every kickoff you'd be starting on the goal line instead of the 20-yard line. So you're starting 20% behind before you even actually launch. So if I look at something that could change, if you could have a SPAC that you both were aligned and both of you started together at the same level, and you both made you got 20% of the ups for everything you made. That's the same thing in private equity for the everyday investor. That's something that I think could really make a big impact and change in the next 3 to 10 years, and I see it happening.
When we spoke, you also talked a little bit about the growth of direct investing in companies and through co-investments or through other means. Can you talk a little bit about that, and what do you think is driving that interest?
So, if you take one of my partners, Mubadala's, started a direct investment team, which I think is very smart. You're sitting on a lot of capital. You're putting your money blindly with Blackstone and Carlyle, which is also very smart. You're diversifying your portfolio. There's also a lot of long-term holds, 20, 30-year holds in companies. You look at the Warren Buffett model, right? If I see a great company and it's at its peak and it's growing at 30%, 25%, why should I have to sell it to get the best IRR? We bought Hewitt from Aon 2.5 years ago. It's an amazing company. It's growing very rapidly. It's going to have a 50+% IRR for Blackstone and myself and CVC. However, why not hold that 20 years? And if you're a sovereign wealth or you're a pension fund, that's what you'd want to be doing. So I do see direct investment to be a very smart move for them to get into. The key is doing it right. And the funds that I have met, the struggle is the people that at Carlyle Blackstone have grown up in the industry. And I'm sorry to use my partners all the time, but I'll throw in a couple, Silver Lake and here and there once in a while, in other firms. But people that came out of business school, then went on to Goldman, learned the banking strategy, then worked their way up on the deal teams, to then running deals and then doing deals. That's not happening in pension funds. So you're going to have to attract talent and pay talent differently than you're paying talent to be a pension fund manager. And if they can do that, I think it'd be very smart. They're trying to do that, trying to get there. CPP is doing an incredible job at it. Mubadala is starting to do a very good job. They've hired a good team. Khaldun is a very, very smart leader in what he's doing there. And I think they'll continue to do that better.
Is that also driving some of the interest in co-investment, where maybe you don't have to quite have the entire deal team in place, so you can work with a partner that you trust and are interested in?
Yeah, it's funny you talk about co-investment. So, Mubadala is my partner as a co-investor. Mubadala gets to co-invest in all of my deals. So if you look at the co-investments that led by a large firm such as Blackstone or Carlyle, what's going to happen is it's just mathematics. The bigger the deal, the less return, right? A Thomson Reuters or a First Data, you're not going to get the 30% IRRs, right? It's just too hard. So the co-investments are coming to them are the ones when they run out of their check size. So those are the $10+ billion deals. So they're only getting to see the deals that are very large. So this way they'd be able to see all of the deals, be able to get a chance to see without the 220, without have to pay the management fees. And that's, it's played up to my benefit. People would say, it's worked well for me personally. However, it's a need, right? So if you're able to sole source transactions and not wait for a book to come, in any process, one of two things can happen. In a good process, you're going to either have to overpay or you're going to lose, and you're going to spend a lot of money and time on it, lose time and money. In a bad process, and I've seen a lot of them, it actually goes the opposite direction. A lot of public health companies that aren't as good as people think they are, they go through a process and they end up getting either a failed process and the stock gets pummeled and then somebody comes back in, or the process just doesn't get the results or warrant the results they should. So, I think you'll see, I think my model should be replicated by others and be able to sole source, $10, $20 billion transactions, working and partnering with CEOs. Companies such as IRI is a great example, or Incom. So Incom is probably the best example, or IRI. But Incom is the largest gift card company in the world, and people say, why gift card? There's so many ways. There's Apple Pay. There's so many different things. People forget that all of us here in the room have credit cards, have Amex cards, have the area that we can do that in. There's still 10 million Americans cashing checks for 12, 11% interest at check cashing places. So for me, the gift card industry, I think, is less of a gift. I like to get away from that term, and I would call it alternative credit. But there's a way that can be used in many different ways. It's not just people that can't get credit cards. You take Uber, for example. When we first bought the company, we did a Uber launch. The CEO of Uber is a wonderful guy. He was great to us, but didn't get it in the beginning. And he did 1.8 billion of revenue his first year in gift cards. And that's not just for people who don't have credit cards. That's people that live in New York or LA and other places that their children were running up their bills quite a bit. So then they go, okay, you're going to get a $50 gift card. They might take Uber X and Uber Pool instead of the black car. So there's things like that are very interesting, and then it's going to win those businesses. So when I bought Incom, I thought, geez, what can I do with this business? I can go help them win new clients, which are going to drive results. So it's not just being an investor that invests in a company, sits on a board and gives ideas. It's running side by side with your CEO to help them go win a Safeway as a client, which is a big distributor. So that helped Incom go from 130 million of EBITDA to almost 300 million of EBITDA, and well surpassed Blackhawk, which Silver Lake bought. So this is to me what used to get done 15, 17, 18 years ago. And I think we need to get back to that as investors, of helping CEOs instead of just giving them ideas and helping them to execute it, is running side by side and helping them succeed in that.
There's been an influx of assets into private equity. People are enticed by the high double-digit returns. It seems like a good long-term thesis, especially if you have a long-term time horizon for investment. But now what we hear is constantly there's a lot of dry powder, there's a lot of money waiting to go in, there's high competition for deals. Is the rate of private equity success sustainable? How do you continue to source those deals and compete?
Yeah, overall, I think it's going to get tougher. I do think returns are going to go down in private equity. It's just, like you said, there's a lot of dry powder and everybody's staying with the course. So it's not like one firm's taking one path, the other one's taking another, right? When multiples when you see no offense to Dean Metropoulos if he's out here, but when you see Twinkies trading at 13 times, you think, geez, how could Twinkies have a 13-time multiple? I think that you will see firms holding back on overpaying for assets like they did in the last couple of years, and then you're going to see you're seeing a lot of people. If you just look at the firms, they're all raising distressed debt funds, because I think the people that paid 13 times and levered it up 6, 7 times are now going to be looking in a situation where they're going to have to delever themselves and recycle. But so all you're doing is just switching money around amongst each other. It's not the model that I'm talking about of actually creating value. Taking an income, getting new businesses, taking an IRI, locking up 10-year contracts of data and using that data appropriately. Or another one we talked about backstage is Redbox. Most people in the audience may have not heard of it, but Redbox, we don't own Redbox, but we have a partnership. I used to chair the company when it was public. There's 4,000 machines in front of Walmart's, Walgreens, go down the list, and you rent videos. You say, who rents videos anymore? Is there even DVD players? Well, you can play it today through video games, and there's lots of places to play DVDs. And they're $1.50. Now, most of us in the room don't want to leave the house. You press the good old on-demand button for $5.99. That's not going to get any lower. But there's a big chunk of the country that is paying $1.50 to have a movie for the night. And what needs to change in that business is the way to actually get that. The people that are paying $1.50 also, going back to income, they may not have you have to have a credit card. So a gift card will be able to allow them to then rent the video for $1.50. But the more important piece is not only are you doing good to these people, but it's great for data analytics and marketing. You think about it, and there's no tool in the world that says Seth Bernstein likes to drink Pellegrino, Propel water, and Seth Bernstein came to store number 141 at 11 p.m. at night and is going to be coming back to store number 141 in the next 24 hours. So now I can start marketing to me, because you have your email and your credit card. I could start sending you coupons to get you to come back for a second trip to come into the store. That to me is going to be game-changing when it comes to a Redbox model.
And with the impact of technology on something like you just laid out there, being able to do the mobile coupons or what have you, is that really the future of private equity targets? Is everybody going to have some kind of technology angle? Are there better ways to use that, or is that a little gimmicky?
No, I think I don't think it's gimmicky. I think in a lot of ways things are moving toward the mobile. Even in Africa, Africa is the fastest growing, fastest growing mobile users. So I think everything is going to, at some point, end up on a cell phone. But there's things that are also not going to end up on a cell phone, right? So I'll go the opposite direction for a second. I know I love Jeff and I love Amazon, good friend, good partner. However, there needs to go back to, if you look at these grocers, the reason they're failing, these retailers, in a lot of cases, is they're just putting the same product that's on Amazon. You have to differentiate yourself. So again, I differentiate myself as back to a community. So how do you make that local grocer a community? A place to cash your check, a place you pay your bills, a place you can do everything at, not just buy groceries, and also something that's relevant to that local market. So am I going to sell a high-end organic product in a lower income area? No. So I do think I think some people have a very unique opportunity, Walgreens in particular. I think Walgreens has an amazing potential. I think, I'm not in the hedge fund world, so I'm not a public investor, but I think Walgreens is trading at a very low multiple and has a great opportunity because it can be what Amazon's not. So, Amazon Prime user, there's, over 100 million Prime users. And on the Amazon product, the average Amazon customer is $88,000 income. So if you're in Detroit, Chicago, Boston, inner cities, you're not leaving your groceries on the front step. They won't be there when you get home. So if Amazon doesn't solve that problem, either by partnering with a Walgreens or partnering, finding a way that you can pick up your groceries and make it convenient, I always thought the post office was a natural fit for Amazon. I'd love to see our president and Jeff come together on something like that, on an initiative. I think it might better also see Las Vegas all go bankrupt tomorrow, so you have a better chance of seeing that. But that would really make a big impact on Amazon and people. You know, you'd be able to get, if you think about it, someone who lives in Detroit is paying $3.50 for a 2-liter bottle of Coke at a local bodega. They could buy that same 2-liter Coke for 99 cents on Amazon. So you'd actually impact that local community, that person's wallet, and then maybe even have payroll. I mean, I know this is maybe Flintstone to Jetsons, but you have that, maybe have your payroll directly debited into an Amazon account where they can buy their groceries and then have cash back without having to pay a 10% fee.
Great. Well, we are out of time, so we will leave it there, but I think this was a great conversation, and thanks for taking the time.
Well, thank you. Thank you, everybody.